Thanks for coming, everybody. I'm Kevin with Blackhawk Capital Partners. I'm the managing partner. I started Blackhawk when I was 27. I remember my first rent check paid to my landlord was $300. Those days are gone, right? I had the, I was a certified financial planner. I was getting welcome waiting leads and doing financial planning for people at the kitchen tables, and selling mutual funds. One of my clients owned, remember you used to get that cable TV guide, the bigger one? In the mail with his company in Milwaukee created those. And I helped them put in a 401k. I grew with them, they grew with me for years, and then they were bought by the Tribune company, and I got to see that whole transaction, right, the pitch book, and shopping a buyer, how all that transaction came to fruition. It intrigued me tremendously, and decided that I think, I would like Blackhawk Capital as managing partner to focus on working with business owners. And to be honest with you, there aren't a lot of advisors that do that. I've heard things like, that's too complicated, or, I just never got into that. So it's not a really crowded space. Wow. Trace is a partner of the firm now. We have 11 of us. We have an office in Mequon and then one in Scottsdale, Arizona, at a remote location. But through the years, I'm working with business owners to help them with their retirement planning, tax planning, asset management. We're a registered investment advisory firm. Schwab's our custodian. And then ran into this ESOP transaction that seemed to fit in some cases. It's very complicated, but I've told many people if I had to sit at a kitchen table doing financial planning and retirement planning, I wouldn't be in this business. It's just, I love the intellectual capital needed for these complicated transactions, and we built a team of people we work with to save. We just took a client $90 million in revenue. They wanted to sell, so we got evaluations done, and this is what the private equity would pay, and this is what you could get by doing this, and this is what you could get by doing an ESOP, and we decided to go to the ESOP transaction, and that's where Rick came in. But I think it's an exciting area. I mean, the demographic, or how many people are business owners in here? The aging demographic, right? We're an aging demographic. I'm going through the same thing. Being the managing partner, how do I transition this business to the next generation? How's the transaction going to take place? What's the best way to do it? Sometimes I think there's so much to think about that you put it on the back burner all the time, right? You say, I'll just worry about that tomorrow. We'll worry about that in a month. We'll worry about that in a year. Then it creeps up on you, right? So our main focus at Blackhawk is we help our clients figure out what direction to go, how to go about it. As I've said, we're an RIA. We manage about $500 million. That being said, there are certain things during an ESOP transaction that allow you to get your stock out tax free. So we have, that's part of the process. But when you're doing, there's so many hands out there, you need so much help in this transition process when selling a business, whether it's a private equity through an ESOP or management. There's legal, there's accounting, there's plan administration, there's Rick's firm. So we're kind of like the financial quarterback, where we meet with you. We say, okay, these are your options based on all these moving parts. What do you think would work best? It's not always an ESOP. It just doesn't always work. But when it does, if it's done right, it can work well. So I didn't click on anything today.
Go down.
You have to forgive me, my sinuses are acting up today for some reason. Your money, your future, your choice is kind of a tagline I thought about years ago in the kitchen table. Business owners, affluent individuals, but mostly business owners, business owner positions. It's funny how, as a business owner, probably remember the days when you were paid last, or not paid at all. And every business owner is wealthy, right? 90% of business owners, the majority of their wealth are tied up in their companies. So how do you maximize that? How do you extract your hard work and get paid for what you did? And that's a difficult question. Again, newer business owners or business owners that aren't ready for transition, how do you circumvent tax liability at the corporate level? We do a lot of work in that area. We manage a lot of, believe it or not, pension plans are back in vogue. Cash balance plans, defined benefit plans, in the right situation. 401ks are important. So we help the client maximize value during the time he owns that company and to extract income from that in a tax efficient manner as well. So what else, like I said, we have done many ESOP transactions, and we had, you said John, a friend of ours, John Steele, had turned us on to Rick Jaye, who is a partner in business transition advisors that we work with closely. They're virtual, like you said, there's 13 of you and you're all virtual, but they're inside. So I'm going to turn the rest over here to Rick, and I'll guarantee you'll be entertained.
Thank you. Thanks, Kevin.
You bet.
Welcome, everybody. If I run out of here, remind me, please tell me that my backpack's here. My daughter is due today to the Queens in Atlanta. So I've got all week long I'm traveling, but every place I go this week, I've got a flight that afternoon out to the con with my wife and my daughter. I won't be there for the delivery, but I'll be there when the babies come out so I can see these two beautiful and gentle little girls. So thank you so much. Yes. I've known Kevin and Trace for quite some time. I do want to make a correction. Kevin used the term exit planning, succession planning. Oftentimes when owners are looking for strategies, I call it a de-risking strategy, because Kevin alluded to the fact that many successful business owners have the vast majority of their net worth tied up in two assets. The equity value of their business, which is illiquid, and the real estate that houses that business, also illiquid. So part of what I talk about, it's not always about exit planning, it's not always about succession planning. Sometimes it's just about liquidity planning around owners of businesses to take the equity value they built up in their business, to place into other instruments, charitable gifts, gifts for the educational funds for their new grandchildren. There's a lot of philosophy around creating wealth and diversifying that wealth to allow owners to do other things. And that's really what I focus on. And there's no perfect strategy, as Kevin alluded to. I've been an owner and founder of 4 different businesses. I've had the privilege of doing 4 separate transactions, taking a company public and running a public company, selling the company to a private equity firm, selling the company to a strategic buyer, which happened to be another public company. And today in BTA, we are 100% employee owned as ESOP. So my privilege has been as both a managing director running BTA, being able to participate in taking our company through that type of transaction. So we do what we represent ourselves. But what you're going to learn today is very quickly, I'm going to go through some general ideas around all the various forms of exit planning or liquidity planning. I'm going to take you through what the math is on an apples for apples basis. So that you understand there is no right answer. My dad was an electrical contractor, and he used to always talk about, some people you meet in life, they think that everything looks like a nail because the only tool in their toolkit is a hammer. And he used to say, if you have a big enough hammer and you're willing to take time and do a lot of damage, you can make a round peg fit in a square hole. But again, how much damage you can do, how much time is it going to take. So when a strategy or concept fits, it's ideal. It's elegant, it's perfect. When it doesn't fit, they're not given their option. So I'm going to take you through the concepts of all four of them. So in the perfect world, this is one of the questions I always ask when I meet with business owners. I said, what if you could sell a portion or all of your business to a ready and willing buyer at full fair market value? What if you could defer and ultimately eliminate the taxes that would be due on the proceeds from the sale? What if you could leave behind a fully tax-exempt organization? In this country, there's only two ways, ultimately, you can be a for-profit company and be exempt from paying income taxes. Everybody familiar with those two ways? ESOP is one, an S corporation, 100% employee-owned corporation. It is exempt, for-profit, but it pays no corporate or personal income taxes on the income that it generates as an S corporation. The other is there a banker? I know that there's a credit union here at this facility. Is there anybody here with that credit union? Is there anybody in this room that's a banker? Your biggest competitor in the marketplace is tax exempt. It's called credit. Law was passed in order to make credit unions available to those that are members and the incentive that they have to be able to provide services. Not they provide better services than a bank. They can sometimes be a little bit more competitive on their depository rates that they pay than their lending rates to their members because they pay more than. You think they have a competitive advantage over you? Yeah, absolutely. Same as ESOP. Owners can participate in a second bite of the apple. A big part of the mindset of business owners is they've been successful in building businesses and starting businesses. But part of their mindset is control. They don't want to give it up. The idea of transitional strategies is one of the things you need to ask your client or if you're a business owner yourself is, are you willing to give up a degree of control? Because if you sell to a private equity firm, you sell to a strategic buyer, they have their own management team. They don't need you anymore. Oftentimes they want you out, they want your management team out because they want to culturize the company in what they do. Nothing else, they want to save overhead. Because private equity buyers and strategic buyers, one thing they know when they buy your company is what kind of rate of return they can get on their investment. Because they sure in the hell know they can drive up IRRs by getting rid of a bunch of heads, and you're the first one to get rid of. So that's an exit. When you talk about exit planning or succession planning, that is the succession or exit planning if you want to walk away. That is the ideal strategy. If you want a check to be able to leave, but be careful what you do and who you partner with in the future because they have a different approach to the way they're going to run your business. Oftentimes it's just shutting it down, dismantling it, taking the pieces that they want and moving it to where their facilities are. Be able to participate in the second bite of the apple. A lot of owners say, well, my company's growing. The economy turning. We have an interest rate through decline. So we see things improving. We don't want to sell it now. I don't want to take my equity off the table because I want to participate in the growth. Well, there are ways that you can go ahead and take your chips off the table, de-risking your personal balance sheet while still participating in the growth. We're going to look at what those are. And then lastly, I find, especially in a state like Wisconsin, states like Minnesota, different than places like California and New York. And I'm not saying that business owners in California and New York by nature don't have the same mindset, but the mindset of owners that own businesses in places like Wisconsin, I find, and the privilege that I've had in working with those owners in the state, they care about their communities. They care about the employees that help their families to become successful. They care about the legacy of the business that either they inherited or that they built, and they want to see it perpetuated within their communities. I call it doing well by doing good. So one of the ideal strategies is that owners that want to continue to improve employee retention, to increase productivity and profitability of the firm, and to improve recruitment and the culture of the company. Focusing on those areas. So then, let's compare the various options. What we're going to do is we're going to compare, and some of these overlap, but the traditional methods of stock redemption. Is anybody in this room familiar with what a stock redemption is? So you actually have a corporation or business, and you basically transfer or sell your stock back to the company. So if you own 1 million shares of stock and you want to sell 50%, what you do is you redeem 500,000 shares back to the company. The company then has a note that it's going to pay you over a period of time. What you do is you still, in that case, own 100% of the company. You just have diluted the total number of shares. So your 100% ownership is about 500,000 shares because you sold 500,000 back to the company. It's a way to create some liquidity without giving up control and ownership. We're We're going to look at a management buyout. We're going to look at a third-party sale or a private equity sale. And again, we're comparing all these, and then we're going to look at an ESOP. Then we're going to focus on how these cash flow. Because that's really the real big question. I find a lot of owners, when I talk to them, they say, you know what, I love my management team. I really want to do something for them. I care about the rest of the people that work for me. The management team is the core of this business, and that's what I want to take care of. They said, what I really do, I'd like to do is I'd like to look at a concept of a management buyout. If I can buy out my stock. I said, okay, we'll show you the math on it. Because it's all about math. The question I always ask a business owner is, if you don't mind me asking, what's your name? Lynn. So Lynn's a business owner. I said, Lynn, so you built this business, and let's just use the examples for $20 million. You got a management team that obviously you care about them, you pay them well, but the likelihood is not one of them has built up $20 million to write a check. Because if so, you probably overpaid it. So the byproduct is they're going to buy the business from you. And to make the math work, and I'm sort of giving you the back page of the story before we start. I'm one who always reads the last page when I get a book, and then I go through and read the rest of the book pretty quickly. But the byproduct is this is the back of the book. If you want to sell your management team, the business, and you want to finance that, you might you're going to carry back a note, and the bank's going to finance a bunch of people that can't sign personal guarantees because they got no assets. So you're going to either sign a personal guarantee, which you shouldn't do. You're selling it to your management team, or you're going to take back the note over the life of the transaction.
Rick, I can't hear you.
Can't hear you? Okay, I'm sorry. So the byproduct is, if you have a $20 million business, the way to make the math work is you got to discount the tax rates because they're having to earn income out of the business, pay taxes on it to net the dollar, to then write the check to pay off the principal and the note. Plus, they have to earn enough to grow the business and cover the interest costs. Are you willing to sell a $20 million business for $12 million? Is anybody in this room willing to sell your $20 million business for $12 million when it's worth 20? Now, surprisingly, I've had the answer a number of times in my career. The answer is yes. I said, well, it's real simple. I'll show you how to sell it to your management team and sell it for a 40% discount, because that's what it's going to take for them to be able to buy it, cover the tax cost and the earnings to write you a check. And that's okay. But what I'm going to show you is, wouldn't you rather have sold it for 20, hopefully be able to participate in the growth of the business in a fair and reasonable manner, so you're paid and your family's paid a reasonable price. And if there's a way that you don't have to pay capital gains tax on the proceeds of the sale, the company becomes tax-free to be able to pay off the debt with no tax consequences, don't you think that's a better solution for you and for your organization? So here's the math in the first scenario. It's a C Corp redemption strategy. We work the same way if it was a management buyout as a C Corp. What I'm showing you here is a $20 million buyout requires $27 million worth of corporate earnings with C corporate taxes, because corporate tax rates are lower than personal tax rates. Combined rates, we're using an average rate, state and federal, 21% federally, we're using a 5% state rate. It would take $7 million of additional earnings, not including interest payments on the note, just to make it simple, to net out $20 million so that you could receive your $20 million check paid over time. You're going to pay capital gains at 29.2, which is $5.8 million, and you're netting out $14 million out of a $20 million sale, paying almost $13 million in taxes. Does anybody look at this math and think that maybe that's a little bit of a challenge? There might be a better way. Almost a dollar per dollar dilution in taxes for a net dollar that you receive. Here's the same scenario as an S corp. Now look at the bottom. I don't need to go through the math, detail by detail. All you got to do is look at the two bottom proceeds. You're netting almost $15 million after capital gain, and the reason why it's a slightly different rate, C Corp tax rates, when you sell stock of a C corporation, there's a 3.8% NIIT tax. The Obamacare healthcare penalty associated with the sale of stock. It doesn't apply in S corporate sales, so there's a slightly lower capital gains tax rate, but now it takes $19.5 million in earnings, excess earnings and taxes, to cover the liability to get out the cash after capital gains. So that's pretty inefficient. Next to the third-party sale. You're selling it, you don't care about the cash flow because it's not your company anymore. You've sold the company outright, so very simply, you have a $20 million sale, an average M&A fee for a $20 million transaction is 5%. You pay it, it's a $1 million fee, so you net out 19. If it's a private equity, I would promise you, you're gonna have to roll in 20% at a minimum back into their pool. I'm assuming none of that takes place, just to make it simple. You're paying capital gains tax at 4.8, you're netting out 14.1, and the taxes and fees are $5.8 million. That's not a bad transaction. You want money, you wanna walk away, you wanna play golf and buy a place in Florida, please don't buy it on the coastline. I live in Florida, it is a disaster right now. Water came in everywhere from Fort St. Petersburg all the way through the Panhandle, all the way in. Some areas, water came in over 10 miles. 20-foot water surge with this recent hurricane that came through. So Tim, you can take some business from Ray Robinson because their office is got flooded in Tampa.
Sorry.
Dave Ottlinger has got 2 deals he's working on as a legal attorney working on right now. I got an email this morning, he's going to be delayed 2 to 3 weeks to get work done because of the floods, both his home and their offices. Good news is, for those who want to buy property, you can probably buy property pretty cheaply in the next 6 months when people are abandoning their homes because they got no insurance. You've got a place in the water, it's affordable, not insured. No insurance company in the country will insure waterfront property for it. There's going to be some great buys of waterfront property if you want to buy it. Here's the C Corporation ESOP. Here's the math. It's pretty simple. City dilution for anything on here, $20 million sale means $20 million to the shareholder. These guys are experts in something called 1042. It's the ability to reinvest money. It works like a 1031 real estate exchange. It's only available to ESOPs, C Corporation transactions. When you sell these 30% of your company, you can reinvest a portion of the proceeds, postpone the capital gain, hold those assets till death. Your family get to step up the basis, they sell off those assets, and you avoid and eliminate capital gains tax, federal and state, unless you live in California or Pennsylvania, which applies. Pennsylvania applies a state tax. They don't comply with the federal tax law guidelines, so they don't allow 1042 in the state. It's a 3.07% state tax rate, and California charges an excise tax of 1.5%. So you're 97.5% tax free. And then the fees associated with the ESOP, I'm just doing an estimate of about 3.5% on a $20 million deal. They're paid by the corporation, so it doesn't affect the net dollars that you receive selling the business. But here's the cash flow. This is something that's fascinating to me. This is the advantage of becoming a tax-free organization. On the left-hand side, if you're looking at an alternative sale, I'm assuming a $20 million company, so keep the math consistent. This is a manufacturing conference. So we'll apply a 5 multiple, which is pretty consistent. Ranges of values of a multiple of EBITDA, earnings before interest, taxes, depreciation, and amortization. In manufacturing range, about 4.5 to 7 times, so I'm just using the 5 multiple. So current net income of $4 million creates a $20 million valuation. 4 million EBITDA times 5 is 20 million. I'm assuming no debt, I'm assuming no excess cash on the balance sheet. So we're just using round numbers to make math simple. I assume the company grows over the next 10 years, so it's going to generate $50 million worth of free cash flow or EBITDA over that period of time. And if you're financing the purchase of this company, the company's subject to paying, or the individuals that own it are paying taxes, assuming $21 million in tax to finance the purchase of a $20 million company, which leaves you with $29 million of excess free cash flow to meet your debt obligations, cover the interest, and cover your overhead. Now, we look at if you were to do this transaction in a tax-free strategy, how do you finance it? The same math, $4 million of net income or EBITDA, 5 multiples, $20 million, $50 million over the next 10 years. If you pay no taxes because you become tax exempt, S Corporation, 100% employee-owned company, you're tax exempt, the full $50 million drops to the bottom line, and it's available to meet your debt obligation. Do you think you can be a little bit more competitive? Ignore the benefits to the selling shareholders. As a company, do you think, for those of you that are CFOs in this room, do you think you can be a little bit more competitive in how you operate and run that business if you're no longer subject to paying any corporate or personal income taxes on the profits of the business? I did a wonderful transaction for 2 business owners that owned a very successful general construction company in Kansas City last year. I got a phone call from these guys. First thing I do is I ask them a bunch of questions. First question I asked them, how old are you guys? And they said late 40s, early 50s. I said, why are you looking at doing an ESOP? I said, because you're a little young. I said, how long have you owned the business? They said, we've owned the business and been growing it for about the last 12 years. I said, you're still young. You've got a long horizon in front of you guys. Do you love what you do? They said, yes. So you're walking away? They said, absolutely not. So I'm going to ask the question again, why are you doing this? Our 5 biggest competitors in Kansas City, general contractors, are all ESOPs. In the last 3 years, we've had our 7 best project managers and project foremen got hired away. We can't continue to compete in the marketplace, losing our best people to our competitors. So we're doing an ESOP, not because we're looking to take chips off the table. We're doing it because we have to do it to become competitive. And we're losing bids on commercial work because they're able to beat us on pricing because they're more productive. They generate more dollars in profitability and margins per dollar of general extent, of general overhead than we do, because their employees seem to be working more effectively. Think about that. Anybody familiar with a grocery store chain called Publix? I sit on the board with the prior CFO of Publix. I've learned a lot about Publix. They were an ESOP before I got into this industry. But I've learned a lot from him in educating me about Publix. If you're a cashier at Publix and you work for 30 years, and these are people that earn not much more than minimum wage, the average cashier after 30 years has an ESOP benefit of between $1.7 million and $1.9 million in their ESOP plan. These are people that earn not much more than minimum wage. Think about that. $1.7 million to $1.9 million in retirement benefits, working for a grocery store chain that generates margins of 3%. I just find that astounding. You're empowering the individuals in society, which is why everybody says, well, why are ESOPs so taxed? Why are there so many tax benefits? It just sounds too good to be true. Except because you got both extremes of both political parties that love ESOPs. You got Bernie Sanders and Elizabeth Warren love it because it's pure socialism at its best. Truly it is. You're giving stock. You are giving stock to a group of working class individuals who would never be able to have the proceeds and the funds that would start up their own company. And letting them participate in the equity growth that they're helping to contribute to within their own communities to grow that company, to empower their own lives and that of their families. And then you've got Jeff Sessions, Mitt Romney, and a whole group of Tea Party anti-tax advocates that believe in it because of the tax benefits. It's amazing. If you go to the National ESOP Association, it's coming up in a month, November 13th through 15th. Every other year. One year it's a right-wing anti-tax congressman or senator. The next year it's Bernie Sanders or Elizabeth Warren. They don't put them on the stage at the same time, they kill each other. But what they do is it's alternating each and every year. I don't really care. All I care about is a strategy that works and it works for society. So what's an ESOP? It's just a qualified retirement plan. Everybody in this room at some point has participated in probably a 401k or profit sharing plan. That's all it is. The question always is, well, why is it tax-free? It's real simple. Anybody in this room participate in 401k? Most of you? Do you pay taxes on the benefits that accumulate within the 401k on an annual basis? No? If you own Microsoft, and Microsoft generates billions of dollars a year in profit, do you pay taxes on those profits as a shareholder inside your 401k? An ESOP, all the stock in the company, is owned by you as an employee inside your retirement account. Retirement accounts are governed and run by something called ERISA. They don't file tax returns. Legally, they don't file tax returns. They file a reporting form called a 5500, and that 5500 tells them how much money was contributed, how many people participate, what the growth of the assets of the plan are. If your company's an ESOP, and the stock is owned by your ESOP retirement account, and you've got stock allocated to you, the ESOP doesn't pay taxes, but it owns all the stock in the company. The company then generates profits because all the stock is owned by a retirement plan. The company's, all those profits and cash stays on the corporate balance sheet are not subjected to paying taxes. If the company's not paying taxes, like on that prior slide on $50 million worth of earnings over a 10-year period of time, and it uses half of that money, $25 million, to pay off the debt, buy your company for $20 million plus the interest, is the company better off? Absolutely, because now it has an extra $25 million on the balance sheet that it didn't dilute by paying taxes. Who benefits from that extra $25 million? all of you that are employees of that company. Because how are valuations done? It's a multiple of earnings, plus the cash on the balance sheet, minus any debt. If nothing else, the company's worth $25 million more than it was when you did the valuation. So that $20 million company's now worth $45 million. If there was 1 million shares in stock outstanding, originally it was $20 a share when the company was bought by the employees. Now, 10 years later, the company's at $45 a share, and you've gotten 10,000 shares in your account. So how much do you have at the end of that 10-year time frame in your retirement account? 10,000 times $45 a share, or $450,000. Did you put a dime into the plan to do that? Absolutely not. Did you help the company grow? Because here's the other amazing thing about ESOPs. Because every employee now starts thinking, feeling, and acting like an owner of the company since they're seeing the attributes of getting stock allocated directly into their account on their behalf. You think they take an ownership mindset? ESOP industry has done studies. My undergraduate alma mater, University of California, San Diego, has an institute called the Vices Institute that does research on the ESOP industry. Ohio State, Rutgers, Keene State, and the other universities I'm familiar with that have programs that do research in the ESOP industry. The byproduct is of the 8,000 or so ESOP companies in America and the 10,000 or so in the last 10 years that have been set up, the studies that show when you become an ESOP, your company's growth rate increases between 3.7 and 4.8% per year. So if you're growing at 5%, you're now, once you do an ESOP, growing at 8.7 to 9.8%. The value of the company under that growth rate is doubling every 6 years. So your $20 million company goes to $40 million, goes to $80 million. It's amazing the growth rate of these companies that take place over relatively short periods of time. The more you grow, the faster you grow, the more cash you build up on your balance sheet, the faster you can pay off the debt, increasing the equity value for your employee owners. Common characteristics, shareholders, what I look for, what we look for in our industry. Typically, probably speak to this also. There's a wonderful ERISA attorney, and again, I don't know all the attorneys we work with. He came up and introduced himself here in this area. We've used him on several transactions around the country, but we've used him on several transactions up here in his firm. The byproduct is shareholders who want liquidity and are tax sensitive. I have yet to meet a business owner, even those that believe in entitlement programs and supporting those that are less fortunate, and I admire that mindset. The byproduct is if there's ways that they can direct their money to places they want to see it go, they'd rather do that than have it directed by excess income taxes. So hence, they're tax sensitive and want additional liquidity. Shareholders who care about their employees. When I meet owners, one of the first questions I ask, after I know a little bit about the company and the financials, I say, tell me about your experience. How do you feel about the people that work for us? If what comes out of their mouth is that they're a necessary evil, I don't even talk about an ESOP. That is a exit, that is a private equity or strategic, hire an investment bank, is what I say. You need to sell the company as quickly as you possibly can. Because that is not a company that's going to work well as an ESOP. Good cultured companies, where owners care about the people. When I talk to owners and they say to me, they're like my family. I've had people that have worked for me for 30, 40 years. I know their kids' birthdays. I've been invited to weddings, bar mitzvahs, bat mitzvahs, you name it. That's somebody who cares about the culture and cares about the company, and that's somebody that needs to consider this concept. Owners that care to maintain control. When you sell to a private equity, I can tell of this experience personally. After I sold one of the companies that I was a founder and partner of, we sold to a private equity firm. Within 3 months, at the first board meeting that they controlled, of which I was a board member, they handed me 5 severance packages of key individuals in our company that they said you needed to let go. So I can't do it. These people that started, they left quality jobs to help us start this company and build it. They said, you didn't quite read your employment contract. We control the board. So you have 2 choices. You can issue them these severance packages, and here's what we're allowing you to give them, or you're terminated, and your entire back end of the transaction is forfeited. Pretty tough position to be in. Good news is, one of those 5 people works for me at BTA. I brought him back. I told him when I did that, I said, I will find another opportunity to reward you in the future. A year and a half ago, he was diagnosed with lymphoma, which is a brain cancer. We will keep him on the payroll, and he shares in every dollar commissions we generate, and will to the day he dies. Protect him and his family. That's the least I can do for somebody what I did to him 15 years ago. Great guy. I'm hoping he recovers. But anybody who knows anything about cancer, that's a very tough one to get over. So for those of you that have some spirituality, as Brad Etheridge, tonight when you go home, please say a prayer for him. He's doing his best to fight that. Owners who wish to protect the current relationships they have with their customers and vendors. Again, this is the altruistic aspects of what an ESOP does. Owners that care about their business, they care about their community, they care about their relationships, doing well by doing good. Major tax incentives we talked about. First and foremost, if you do the transaction structured properly or in the right corporate structure, owners can defer and ultimately eliminate the capital gains tax, state and federal, unless you live in Pennsylvania or California. These are an incredible team. It takes a very unique specialty investment group, investment banking group, investment group that knows how to build these and structure them properly. Companies, when you do partial transactions, because the other thing about ESOP that's wonderful is you don't have to be 100% sale. We were an ESOP. When I first joined the firm, I mandated, and I said to the two founders that brought me in, I said, if I'm going to join the firm, two things. I'm not working as a W-2 employee. I'm past that. So if you're going to bring me on, you're going to bring me on as a partner. Secondly, how can we not be an ESOP? What do we sell? We sell ESOPs. When I go to buy a car for myself, back in the day, my kids, my wife, first thing I do is I walk around the dealership and I say, what kind of car do you drive? I'm going to find whoever it is in that lot that's driving the car I want to buy because I want to know the good, the bad, and the ugly about my car. I've already committed to buying it. In my mind, I'm buying it. But I'm not buying it from somebody who's not driving it. How can you do business? I said this to every business owner. How can you do business with a firm that's touting that they do this day in, day out, and they're not one of themselves? So the first thing we did before I joined the firm was we did an ESOP. But it was a partial ESOP. We are now a 100% employee-owned company. Because after last year, I mandated we become 100% owned. It's what convinced my daughter, who was at Google for 13 years, to join us. It's like, Dad, I thought we were doing your firm. This is what I get where I am. I get what you wanted to deal with the stress. She comes on board January, she lets me know on January 31st she's pregnant with twins. Oh, you couldn't have stayed at Google for all of that. Saving less than 5 months of while you're taking maternity. But anyway, the byproduct is we are and we live and breathe what we position because it's a great thing to do for your communities and protecting the legacy of the business. And because it's partial, the second point deals with this. When you're a partial ESOP, you can't be 100% tax-free because you're only tax exempt to the percentage that is owned. So that was one of the reasons why I was able to convince my partners as of last year to do 100% so we can become 100% tax-free to afford on a tax-deductible basis, paying off the debt, and let all the employees of the company share in the wealth and the value of what we're able to grow. Not just because of my daughter. My partner's daughter works for our firm, the other partner's daughter, niece works for our firm. So we believe in that because of what we do, and we shared in the sort of the value philosophical proposition, doing well by doing good. It's a neat concept, and where it works well. Profits of the company become 100% federally and state tax exempt. What I didn't talk about when you do 100% sale, when I did mention the idea behind the math, participating in the second bite of the apple or the back end, when you do 100% sales in ESOP, the owners are able to sell the company for the full value. Now I showed you the $20 million, collecting the $20 million for the sale. You also participate in something called a stock warrant. It's an equity kicker. Simple way to think about it is you participate in the second bite of the apple. You still participate in the back end of the growth of the company, depending on what the accelerated growth rate is. So they're not giving up anything by selling it today, letting the employees benefit over time by still sharing in some of the growth that takes place. And those are subject to long-term capital gains. You can structure this in a way where participants in the ESOP can benefit by converting those shares that they get early in the time frame to a Roth benefit. So in the early years, you're all going to become intellectuals in how valuations of businesses are done. Pre-ESOP, Since an ESOP is a leverage buyout, you leverage up the company to borrow against the stock value, pay out to the owners. So in valuations, it's a multiple of EBITDA. Different industries sell at different amounts. We just use 5. 5 times $4 million is $20 million. Next, what you do, that gives you what they call enterprise value. You then add the cash or securities in the balance sheet to that number. So let's assume that $20 million company is holding $2 million in cash. So now you have a $22 million value, and you subtract out any debt on the balance sheet, and that gives you equity value. So very simple. $20 million, and let's say $2 million in cash in the balance sheet for working capital. So that's $22 million in value, and you got no debt. So we have a $22 million equity value that that company is worth in the marketplace. Tomorrow I buy it from you. We do an ESOP, and we leverage that company up with $22 million in debt. Because the cash has to stay there. We can't strip the cash because we need it for working capital, right? But you're due the full $22 million. When we layer on $22 million in debt, the day after you close the transaction, how much is the stock value worth? Is there an accountant in the room? Because I'm going to pick on you right now. Please raise your hand. For GAAP accounting purposes, going back to the math, 5 times $4 million is what, 20? Plus the $2 million in cash, it's $22 million. We have debt on the balance sheet now, which is how much? $22 million in debt. What's your equity value or stock value for GAAP accounting? It's 0. Now, the IRS doesn't let us use 0 as a valuation. There's a second value that's done, but it's pennies on the dollar. Now imagine you're an employee. You work for BTA. You just get your stock statement in the first year, and you got, just make it simple, got 1,000 shares of stock in the first year. But the stock value, because of layering on, in this example, $22 million in debt, stock value is, let's say, 30 cents a share. 30 times 1,000 is what? And you Roth the $300 in your very first year. So you pay taxes on $300. So it costs you maybe $100 in income taxes on the $300. 10 years down the road, all the debt is paid off. We built up, in this example, $25 million in cash for the balance sheet, plus the company has grown. We showed a 5% growth rate, so now the company's doing $6 million in EBITDA times the same 5, that's $30 million plus the $25 million in cash we built up. We're at $55 million, so the million shares in stock is now worth $55 a share. What's 55 times the 1,000? $55,000, right? Cost you $100 in taxes originally. You take out $55,000 now tax-free. You think that's good for your employees? Think about the wealth that you can create for the people that work for you that have helped you and your families become immensely successful. Imagine what you can do to change their lives. Warrants, that's the second bite of the apple. This is where good planners, so part of the work that they do is not just on the investment management side, building these 1042s, working with owners, it's also doing the planning. And what most of our clients end up doing is that second bite of the apple, those warrants that are granted right after the transaction is completed, because the stock value is so low, owners take those warrants as a package and they give them over to their kids, dynasty trusts, family partnerships, so they can pass those gifts down without any estate tax consequences to the future generations. Amazing planning that comes around these transactions. And here's the ultimate math. This is an actual case, a $20 million transaction. Client got $8 million of bank financing at closing. They took back a $12 million note at 5.5%. They collected over the 10 years on the interest in the note $3,624,000, and the warrants in the back end had an estimated value of $9.4 million. So they sold a $20 million company and collected $33 million over that time frame. It's the equivalent of an 8.26 times multiple. For a manufacturing company that currently is selling at 5 multiple, that's not a bad financial outcome. So here's a case study. You know, the mistake I made is I didn't put in a manufacturing case study because we could have used one out here in Wisconsin for that. So this was a relatively small transaction. This is not abnormal. $13.2 million. It was 5 shareholders. They were of different ages. We got brought in because they had 2 shareholders in this group that wanted out. The original idea was the 3 younger ones were going to buy them out and was going to continue moving in that direction. So there was a 69, 67-year-old. They were the first 2 that were going to get bought out. The next guy was 63, and that was really the operating CEO of the company. And then they had 2 40-year-olds that were the individuals that were going to be the last person standing that were going to do the buyouts. We got brought in to look at doing an ESOP to see if that would be a better alternative, and all 5 ultimately made the decision they wanted to sell. So this goes through just some of the basics, what the purposes were, why they did this. The solution is we created an ESOP. They chose to sell 100%. They had a pretty significant, so they didn't do the 1042, which is that ability to avoid the capital gains, because they had a large AAA balance, 13.2 million. So because in an S corporation, a AAA balance is basically the non-taxable portion. The portion that owners have already paid K1, picked up as K1 income during their lifetime operating business, they pay personal income taxes on, that they've let that profit stay in the fork. Still part of the equity of the company, but it's non-taxable. So when you evaluate that, the capital gain tax treatment is relatively little. The benefits, they got $6.2 million in cash at the time of closing, which primarily went to the 2 retiring shareholders. The rest of the shareholders took notes back, and for that, they got 100% of the warrants. The warrants ultimately had an valuation of $4.7 million. That was the estimate. And that's all predicated on the growth of the company. I stay close with this company. The warrants are a fraction of what they're going to be, because now for those of you that believe in growth through acquisition, if you're an ESOP company and you're 100% tax-free, imagine what you can do in acquiring your competitors or local companies if you want to roll in, if you don't are subject to paying any income taxes. You buy them with their cash off their balance sheet, you buy them at a discount, it becomes accretive the day you acquire them to your stock value, so everybody benefits. The day of the acquisition by increasing the stock valuation to you. And typically the debt gets paid off for buying them in anywhere between 18 to 24 months. It's an amazing process to grow your company through acquisitions. And what they've done is they've acquired 3 different companies in their marketplace. The projected equity value of the warrants is going to be closer to $10 million, almost the full value of what the original price was when they sold the company at the end of the time frame when all the debt is paid off. So who's a candidate? From our perspective, it's an owner who wishes to sell a portion or all of their business. They've got current EBITDA of $2 million or more. They've got $1 million of payroll. That has to do with the way you fund the plan with 20 employees. They have a strong succession team, somebody that can run the business, or they're willing to stick around and continue to operate the business. You don't want to look at the strategy for an owner that hasn't built a bench and wants to walk away the next day. That's not the ESOP. That is not an ESOP, because they've got risk. They're taking back a big seller note. They got the warrants in the back end that they're banking on being paid. And if you don't have a bench that's already successful running the business, you sure as hell don't want to transfer the business over to people that haven't demonstrated they can run it properly. $10 million or more of current equity value, and owners who are tax sensitive and most importantly care about their employees and the legacy of the business. My name is Jaye. Appreciate your time today. Thank you. We'll turn it back over to Kevin. They're going to talk about the 1042 and that transaction.
Thanks, Rick. Appreciate it. As Kevin mentioned, I'm Tendick, part of Blackhawk. We'll just go real quick through this and not into a ton of detail, but if anybody is interested in more detail, we'll be at the booth later on as well. We'd like to dive into some fun stuff. Major tax incentives was sort of the tone of a lot of what Rick talked about. And with that 1042, it's the indefinite deferral and elimination of capital gains taxes from the transaction. Again, a lot of words on there, but I think the key takeaway is if anybody's familiar with 1031s in real estate, similar type process where there's rules and timelines that need to take place, and you need to make sure that the firm that you're working with to go through those steps knows exactly what's going on and is capable of.
And you can also do a partial.
Correct, yeah, you're not required to do a
1042, you could do, say, well, I'll just do $5 million out of the 10.
Yeah, and a lot of people look at it and say, hey, I love the idea of never having to pay taxes on this transaction. Some people are comfortable paying their fair share, but like the idea of being able to time taking that gain and paying that tax based on what tax rates are going to be. And obviously, with the ESOP, and as Rick had walked through that transaction, most of those proceeds aren't actually being paid out to the owner for a number of years, and who knows what tax rates are going to be in the future. So this is a way to provide some hedge to provide some protection around that as well. What do we have to buy? So again, like a 1031, there's restrictions and parameters around what we can buy, and we guide through that process. We've got 12 months post-transaction to make sure that every piece is purchased to allow for as much deferral as what we want. And anything that gets sold after that, electively of course, that would trigger the taxes on any of those deferred gains that would take place. Some of the challenges that go along with that, again, when you're receiving a portion of the proceeds at closing, and in Rick's example of a $20 million sale, if you're only getting $8 million at closing, and you want 100% deferral, we need to come up with $20 million worth of qualified property purchased, and so we need to either finance or utilize some margin or some type of financing to make sure we're buying as much of that qualified replacement property as what the exiting owner is looking to defer. Yes.
So, let's say you qualify for 1042, you buy a share. At some point, if you sell the share, are you taxable?
Correct, yeah, so it can be just a tax deferral strategy. So again, if you're comfortable and say, I'm fine paying taxes, I like where capital gains rates are right now, but we've got an election coming up, and cap gains rates may, who knows, double. We don't love the idea of paying at that. You can hang on to that QRP, and in 10 years, we're back at 20%, and you want to trigger it and pay your 20% and walk away. Great.
Again, you don't have to sell it all, or you don't have to do the whole transaction.
Yeah, again, you can piece it off and say, okay, we're in a comfortable tax environment. I'd like to peel off and realize 10% of the transaction and the taxable gain at that point. That's fine.
Or you have losses, right, on other trends like stocks. Yeah, or on other transactions where you have a loss, and then you can sell your 1042 part of it to offset that loss. So you can time it every year.
Yeah, and again, the long play is that if you have an exiting owner who is just against paying taxes in any regard, you hold that until the day you pass away, and then you get a full step up in basis on that qualified replacement property, and then there's no taxes due.
Or they move to a non-tax state.
Correct. Also.
They don't want
Right.
to pay the federal tax, but they don't want to pay the state tax.
That wouldn't be Wisconsin.
So again, as Kevin mentioned, we're a local firm, offices up in Mequon, Scottsdale, Arizona. We partner with Charles Schwab as our primary custodian, and we do all the work on the back end, both the 1042 and the other aspects that support the transaction and liquidity that needs to go along with making sure that the business has appropriate resources to be able to pay out not only the exiting owners, but importantly the employees that are now owning the shares of the ESOP in their retirement plan. We want to make sure that we have funds available to pay them when either they terminate from the company or retire or God forbid pass away at some point in the future. So that's Blackhawk. Feel free to scan the QR code if you want to have our contact information. I passed out folders if some of the later arrivals can get one. I've got more up here. Feel free to stop by and introduce yourself. We'd love to talk. Thank you all.
Thank you.